Today we're going to go through exchange-traded funds, or as they're more commonly known, ETFs. ETFs can be found in your book, section 1.3.8. Before I start each presentation, I like to go through 3 things that will help you remember what the type of investment or the topic is all about. In this case, those 3 things are lower fees, transparent trading, and complex. ETFs are extremely complex. Now, ETFs have been around for about 10 to 15 years, which actually in the investment world is not a very long time. You've probably heard about them in the news or just in discussions with people. People about 5-6 years ago got really excited about ETFs and really started to invest in them a lot. And what's important to remember about ETFs is that they mimic an underlying investment. So this actually means that they are following an index or an investment. In this case, not in this case, for example, the SPX 500, or they could be following an industry like the airline industry or the mining industry, or really any type of industry. Now, ETFs are extremely transparent and they trade on the stock exchange. So your investor can really see the increases and the decreases, all the fluctuations within their ETF, and they can see those trades every single day. So it really gives a lot of comfort to sort of a finicky investor who's really worried about what's happening with their investments. ETFs are professionally managed, and so with this comes along with all of the benefits of professional management. They have a manager who actively trades and actively pays attention to what is going on with the ETF, and really to make sure that the ETF is properly following that index or that industry that the objective is associated with. So the manager will choose investments based on a fund objective. And as you know, there are varying types of fund objectives. A couple examples would include capital growth. So your investor is really looking for a capital growth investment, capital growth in their investment. That would be more of an equity investment that they're seeing from their manager. And another example would be an income growth, that should say income. And that's a dividend investment that they're going to see with that. So income growth, dividend investment. Now for you as the advisor, this really benefits you because it allows you to customize your client's portfolio and really give them something that's reflecting exactly what they're looking for. So it reflects your customers' fund objectives or portfolio objectives. And next we're going to go through fees and returns. And the great thing about ETFs is that they are extremely, extremely cost effective. Similarly to a mutual fund, they do have an MER, or as its long name, a management expense ratio. And this is a fee that's associated with mutual funds and ETFs. However, the cost is considerably lower for an ETF, so your client is not spending as much on expenses, and so they're getting a better overall return. However, unlike a mutual fund, you do have a TER, which you can see is a trading expense ratio. A trading expense ratio means for each and every charge, for each and every transaction, there is a charge. So every purchase, every sale. So if you have an ETF, like for example an international trade fund, the more active the ETF, the higher the TER. Or if you have a money market fund, you'll get a lower TER. Now, ETFs are bought and sold at market price and on the stock exchange. And their distribution really is like the distribution of any investment. So you have ETFs that pay their distribution or distribute interest, dividends, capital gains, or cash. And these distributions can happen at any fluctuation, so monthly, quarterly, semi-annually, and annually. Now, what's important, as always, with any type of investment to remember is the longer that you leave it in, the better it is for your investment. So that means like really investing in the monthly is better really investing in quarterly would be better for your client than monthly. Capital gains are the only ones that don't follow this distribution or frequency pattern, and they are distributed on December 31st, the same as all capital gains. There are so many different types of ETFs, it's impossible to name them all. So we're just going to name a couple things that they track. So ETFs track or follow currencies, industries, commodities, or bonds. And you can purchase ETFs through a securities dealer. Your securities dealer must be licensed through IROC in order to make the purchase. And so because this is an IROC purchase, they are sold by prospectus, and you also receive a fund fax with this. So a fund fax really is specific to that ETF and has all the details and the ins and outs about that specific ETF. Now, just like mutual funds, there are varying types of risks in an ETF, low, medium, or high. And there is also some liquidity risk, which we'll talk about a little bit later. You must have an investor in order to sell an ETF. And speaking of investor, there is some investor protection with an ETF. The CIPF offers some protection, which is the Canadian Investor Protection Fund, and that's $1 million, and only for dealer failure. Now let's go through the advantages and disadvantages. You'll find that we've probably covered a lot of these already. So diversification, you can really set up your portfolio as your client wants. They are extremely convenient, and they trade on the stock exchange, so they are transparent. And fees, so the lower MER that we talked about earlier, and there's also no sales load, so there's no front-end load, back-end load, or DSC fees associated with a ETF. Now, there are some disadvantages. There are not too many, but there are a few. So TER, we already talked about that. The more active it is, the more that it costs. The low liquidity I mentioned just a couple seconds ago, so you do need to have a buyer in order to sell this. So if you're investing, this needs to be more of a long-term investment because you don't know if you'll have somebody to buy your ETF when you're ready to sell it. So there is some risk associated with that. And they're extremely complex, various options, combos, and it's really important to get advisor advice when investing in ETFs. And that's it.